Good afternoon, everyone. I welcome you all to ET Reality webinar. To present this webinar, I welcome Bhairav Dalal, Partner, Real Estate Tax, PwC India, on the topic REITs moving into the fast lane. There will be a presentation on the topic followed by a Q&A session wherein you may submit your text questions to today's presenter by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the presentation. We will collect these and address them during the question and answer session and the end of today's presentation. Now I would like to invite Bhairav Dalal to start the presentation. Over to you.
Thank you. So good afternoon, everyone. I hope you guys have had a good week at work. And I would like to thank ET Reality for giving me this opportunity to express my thoughts on REIT, a very important topic in today's time, especially with the growth agenda this Indian government has. Before we proceed, I think it's very important to mention, and some of you may already know this, but it's extremely important to give credit to our regulator, SEBI. They've done a fantastic job in writing these regulations. They have been very proactive and very, very business focused. They want to create this as a product for every real estate investor in the country. So it's very important that we give due credit to them while we are talking on this subject. What is a REIT? REIT is effectively a part of the real estate ecosystem. Real estate, as you would know, is a very important sector for any developing nation. For example, India, it's the second largest employer after agriculture. And if we collect the ancillary industries, my guess is it will be very, very close to agriculture in terms of creating employment opportunities. It has given tremendous growth to our country in the last 10 years. However, what has happened in the last 10 years is it has created a lot of commercial assets, and the logical next move for any real estate ecosystem is to get into the mode of REITs. Now, very, very generically explained, REITs is nothing but a mutual fund, and like a mutual fund invests in listed securities, REITs invest in properties which are generating rental income. When they generate rental income, effectively the REIT unit holders get a part of it as dividend. That's similar to any other dividend mutual fund. So mutual fund has been in the market for many years. People have been very, very comfortable investing in mutual funds. REITs is the mutual funds for real estate. The benefit it gives to a general layman investor is you don't really need to own the real estate, get into the hassles. It's like a hassle-free investment as far as real estate is concerned. And it also gives you the opportunity to invest and ride the upside that is there in the real estate market today. Globally, REIT has been around for more than 50 years. In fact, if you would see on this slide, US, it was introduced way back in the 60s. And the number of active REITs in the US market today is 191. And subsequently, a lot of other developed nations have also been adopting REIT as a product. There have been successful ones, a few have not been so successful in implementing this. For example, Hong Kong has been a market which has struggled with implementing the REIT in the way Singapore and Japan has done it. In terms of last few years, a lot of interest has been generated amongst global investors to invest in Asian REITs, especially because of the underlying properties they own. For example, Singapore has seen a lot of inflow in the last few years. A lot of global players have looked at setting up a REIT in Singapore. Singapore today has many REITs which have assets in Europe, in US, in Philippines, in Australia, in Japan. So it's becoming a global hub for REITs. We are hoping that India soon joins this list. given the growth potential we have and given the number of properties that are there in India, which can really be taken into REIT. We are anyway seeing a lot of foreign investment in these properties. If it can be routed through REIT, we will certainly be one of the biggest markets in REITs globally. So what has been the story so far? As I said, a lot of credit needs to be given to SEBI. SEBI released the first draft in 2013, but it released it as a draft for discussion with the stakeholders. And I recollect going back to 2013, there were a series of meetings which SEBI held with a lot of stakeholders, consultants, lawyers, advisors, bankers, a lot of property players, a lot of discussions within the government departments. A lot of inputs were taken before the final regulations for REIT were released in 2014. In fact, when the regulations were released, the feedback that SEBI had got was they need to broad base the regulations and include other sectors, which is why the regulations, when they released, they were in two separate forms. One was for real estate and one was for infrastructure. Now, the way globally the story has been, for any REIT to be successful, there has to be other fiscal benefits. Fiscal benefits in terms of stamp duty exemptions, fiscal benefits in terms of tax benefits, pass-through status, reduction in dividend taxes. All of those things have been globally available to a REIT product. The same request was made by SEBI, by the industry to the finance ministry, and over the years, finance ministry has made those changes in the tax regulations, and ultimately in May 2016, the law was fully amended to give REITs a pretty much a tax pass-through, and we'll see in detail what the tax implications are. But the overall story has been very, very encouraging from the regulators as well as from the finance ministry, the two main participants in getting REIT to the shape and form that we have today. So the benefits of REITs, why would someone really look at REIT as an option? What benefit does it give to a developer of commercial assets, to an investor in commercial assets? Why would someone really go after doing this? Primarily for the developer, it's an exit mechanism, or it's basically a cash out mechanism. We all know commercial assets require a lot of funding. It's a very asset heavy model. Once the money is gone into development phase, the payback period for that is a pretty long one. And if we need to address the need for many such grade A properties, we need to find an avenue where the developers can easily raise capital and flip their assets into the REIT so that they can move on to another property. It's a clear-cut market available. So from a developer perspective, it's a super model. They develop, flip it to a REIT and move on to the other development, which is really their core strength. From an investor perspective, it gives a great benefit because you don't need to really go and buy the hard asset. You can buy units of REITs, which is much more liquid, which is much more easy to manage. There is no stamp duty cost in terms of transfer of properties. It's effectively a security, so you can trade in it, you can buy it and sell it. It gives great flexibility. The other advantage, which is really the advantage which a country like India needs to have right now, is our banking system has got a lot of exposure to a lot of these assets. Once REITs happen and the developers are able to pay out the banks all the funds that they raise through REITs, banks' exposure to this sector will reduce significantly, which will then give them the flexibility to again lend more during the development phase. And that's really what our country needs today in terms of developing grade A assets in most of the cities, not just a couple of them. What we are really hoping is that these benefits start playing out in the Indian context. And once they start playing out, I'm pretty sure we'll see a very active REIT market, just the way a Singapore or an Australia is today. Moving on to the REIT structure, the boxes and the triangles which form part of the structure as we draw on a piece of paper. The real constituent of this is going to be the investors, because at the end of the day, this entire thing is being done by the sponsor group to facilitate investment. The way it will work is a trust will be created. The trust will be registered with SEBI. Once it is registered with SEBI, all the assets of the sponsor group will move to the trust, and then there will be an IPO. It is a very similar process to an IPO, because the SEBI will ask for a draft prospectus, will ask for a final prospectus. The prospectus needs to contain detail of all the assets, all the liabilities, the due diligence need to be done. It is like a classical IPO. Once the IPO is done, you will have the usual constituents, which is a trustee, the manager, the project manager for particular assets. You'll have the auditor for the trust and the companies. You'll have a valuer who needs to do valuation of the properties as well as the companies on a regular basis. These valuations will be available to the investors on an ongoing basis, just the way NAV is available in a mutual fund. I mean, today, most of the people invest in mutual funds looking at the NAV of that particular mutual fund. It is going to be exactly the same model where NAVs will be available for each REIT, and there will be valuations done for each of the assets which the REIT owns. The role of the trustee is going to be in the fiduciary capacity to take care of the interest of all the investors. The manager needs to manage the trust the way it manages a fund. Therefore, all the investment, divestment, and day-to-day decisions will actually be the responsibility of the manager. When we look at the key regulatory aspects for REIT, the main one being the sponsor. Here, sponsor is equal to promoter in a general IPO context. When you look at a sponsor, the sponsor needs to be a developer or someone who has been in the fund management industry for at least 5 years. The developer needs to have a track record of 2 developments, 2 completed projects, which is very important, because there has to be confidence amongst the investors that the promoter who has developed these assets has the right potential. And anyone who has less than 100 crores of net worth is not eligible to be the sponsor, purely because these are very, very capital intensive assets. We want the right kind of sponsors to be there in the market, not someone who really doesn't have the wherewithal to hold on to these properties for long duration of time. Same way for a manager, given that the manager is likely to be the key guy to take decisions for investment, for divestment, for project management, they need to have the right kind of experience, not just the entity. They also need to employ people with the right kind of experience, who have been in fund management, who've done this, may not be in the REIT context, but maybe in a private fund context. When we look at fundraising as an option, fundraising minimum asset size has to be 500 crores, minimum 200 investors. You need to have 25% of public float, similar to how it has to be in a listed company during an IPO. The additional point here is the post IPO, there has to be a lock-in for the sponsor, 25% for 3 years, and 15% at all points of time. So even if the sponsor is really exiting or selling out his stake, at all points of time, they will need to be at 15%. So they will always have that much skin in the game without really moving out 100%. There is a provision available if they want to move out of the sponsor lock-in from the 15%, they need to find an alternate sponsor with the same eligibility requirements. Only then someone else can step into their shoes and continue with the 15% requirement of lock-in. From a distribution perspective, the way the regulations work, 90% of the distributable cash flows has to be distributed. This is a global model. We have ensured that we are not at a disparity with some of the global REIT models. It is a dividend product. All the free cash flows have to be made available to the investors on a regular basis. We've kept 6 months as the threshold. Every 6 months, the REIT needs to make that distribution to the investors. This will ensure that there is no extra cash sitting in either the SPV or in the REIT. They are distributed as soon as possible to the investors. In terms of in terms of REIT holdings, 80% has to be in rent generating assets, because it is really, as I said, is a cash flow model. Whatever cash comes in has to be distributed to the investors. The investors are not taking any substantial risk in terms of development of these assets. The risk really is only to the extent of 20%, if at all there is any, because the maximum allowed is 20%. The assets which are there needs to be completely rented. 51% has to be completely rented. REIT can also borrow. In terms of borrowings, the borrowings is capped at 49% of REIT assets. So there is a model available for REIT to borrow from the market and buy more assets. If it is borrowing beyond 25%, it is only with unit holders approval and subject to credit rating, which effectively means a good manager can do leverage at domestic level, go out there, raise some more money through debt and buy more assets. This will only increase the return to the unit holders. Now, as I said, the REIT can invest in only some classes of assets. The assets are pretty much defined in the regulations itself. It certainly can't invest in land or agricultural land. It has to invest in completed assets which are rent generating, and there's a lock-in of 3 years. So it's not as if it can invest in properties which are only developed but not yet leased out. 51% of the revenue needs to be locked in today on the day when REIT is investing. As a unit holder, as an investor, you'll have complete clarity through the prospectus as to which assets are you investing in, who are the tenants, what is the tenancy duration, is it a long-term contract, is it a short-term contract. Everything will be available to you through the prospectus. The balance 20% of the fund of the REIT assets can be invested in under construction properties. This is again increased from 10 to 20 in very recent times. In terms of risk, yes, the risk increases, but so does the return. If these are partially constructed properties and if they are good properties with the right kind of tenant mix, this can certainly increase the return to the investors. It can also invest in listed and unlisted debt of real estate companies. Now here also the underlying real estate companies need to be having a similar model. Excuse me. It can't be investing in companies which are doing development. As long as the real estate companies are having assets which are stabilized and which are rent generating, REIT can invest. REIT certainly can't invest in TDRs in FSI more than 20%. Obviously, you don't want REITs to start taking these sort of development or trading risks. And it can also do some sort of treasury operations by investing in government securities, money market instruments, mortgage securities, etc. If you see the way the REITs regulations have evolved, there have been a lot of changes in the sponsor regulations, in the asset regulations, and a lot of clarity and flexibility has been provided in the last 24 months by SEBI. That is where we really feel that the regulator is doing everything possible to make this a successful product. It is now really the industry which needs to take this forward. Moving on to the tax framework. Let me quickly explain to you the way this slide is organized, and then we can go into how at each level there's a tax implication. On the left side, you have the sponsor. Sponsor really are the asset owners today. Then you have the investor. Investor is really the investor, either it's a domestic investor or a foreign investor. Then you have the REIT. REIT is essentially the trust which we saw in the earlier slide. And then you have the asset SPVs, which are really at the bottom of the chart, which own the assets. Now, step one is the setup phase. During the setup phase, you will have the sponsor owning the assets and taking them and migrating it to a REIT. The entire migration process can result in capital gains under the Indian tax law, but there is a specific exemption provided for any shareholding that the sponsor has and which is migrated to the REIT. Now that's a pretty big capital gains tax which is exempt. There could also be minimum alternate tax. Minimum alternate tax for any sponsor, which is like a corporate entity, is deferred till the sponsor actually monetizes those units. So unless and until there is a cash event, the MAT is not applicable. Same is for any investor in the asset SPV today. So anyone who owns an asset today flips it into a REIT, there is no capital gains tax. Minimum alternate tax is deferred till the day of monetization. Moving on to income recognition and distribution, there is asset SPV. We should look at from the bottom because the income distribution will happen from the bottom level. The asset SPV will obviously pay its basic corporate tax. When it remits the money, it could remit in the form of interest or it could remit in the form of dividend. There will not be any tax leakage either in the form of dividend tax or in the form of withholding tax when the asset SPV is paying to the REIT. REIT as an entity is tax exempt. It does not need to pay any tax on any income that it has received from the asset SPV. Now, when it pays the funds to its investors and sponsors, it has to see whether the investors are domestic or foreign, and it has to see the underlying income. If it has received dividend from the asset SPV, then whatever it pays to the investor is tax exempt. If it has received interest from the asset SPV, whatever it is paying to its investors, if it's a domestic investor, they have to do withholding of 10%, but the investors pays balance 20% tax. For the REIT, when it pays to a foreign investor, it has to do a withholding of 5%, and then the investor does not pay any further tax. That's how the entire income distribution happens. Exit. When, as an investor, you exit on the stock exchange, these are listed products, although the holding period is 3 years. But once you sell on the exchange and it is a LTCG, long-term capital gains, it is exempt from tax. If it is a short-term capital gains, it is 15%, just like how it is for any other listed equity. The only difference here is the holding period of 36 months as against 12 months for a listed share. When the REIT sells any of its asset SPVs, it is a taxable transaction. There is no tax benefit on that. And so is the case where an asset SPV sells the asset from the SPV to any other person. There is that capital gains tax at that level also. Those are not yet exempt from tax. So this is how the entire tax framework works. Obviously, any trade on the stock exchange will be subject to a securities transaction tax, just in the case of listed equity. One more important factor is the exemption from dividend distribution tax in the income recognition column for the asset SPV is available only if the REIT is owning 100% of the shares of asset SPV. It is not available if it's a 50% shareholder or if it's a joint venture with anyone else. Again, here a lot of credit should be given to the finance ministry for coming up with the exemption on dividend distribution tax, given that this is a model which is going to work completely on distribution of dividends. This was an important step. Once this was done, a lot of players actually started looking at REITs. Until then, because of the tax cost, it was not really a viable product. So based on the way the tax rates are today, what we've done is we've put together an illustrative chart of how effective tax rate would be for a domestic investor as against a foreign investor. Now, the way the interplay is, for a domestic investor who is investing in a REIT, the ultimate total tax rate is likely to be 34.61, which is really the corporate tax rate in India. This is because all resident Indians are ultimately taxed at the maximum slab of 30% plus. However, if you see, for a foreign investor, it is more beneficial if there is a debt equity model which is there between the REIT and the asset SPV. And as you would observe, the more debt in the asset SPV, the lower the tax rate for the foreign investor. Now, this is particularly because of withholding tax the way it is for a foreign investor as against the total tax rate for domestic investors. Obviously, these are very, very basic comparison. There could be different rates for domestic individuals. There could be different rates for mutual funds because of partial tax treatment. Some of the insurance companies have a lower tax rate. So those all variations would be there. But what we wanted to discuss here really is the interplay between a domestic shareholder or a unit holder of REIT as against a foreign unit holder of REIT. And if there's a REIT which is largely going to be subscribed by foreign investors, for you to give better return to them, it has to be a good debt equity mix so that the returns are optimized. Now, obviously, there are certain challenges with respect to migration to REIT. It's not something which is a 100% completed product. There are certain provisions which still need to be fine-tuned further. A few of them are on this slide, as you would see. There are cases where there is a two-tier structure. Two-tier structure really is a holding company which is having multiple SPVs below. If you want to migrate this entire holding company to a REIT, the SEBI regulations allow it, but the income tax law still needs to be updated to give all the benefits that we discussed to this particular structure. What is also not there, as we discussed on the earlier slide, is if the REIT sells any of the SPVs below, it is subject to a full capital gains tax. That is not yet passed through to the investors. In some of the jurisdiction, this is something which is there and has been there for a long time, and we believe this is one of the critical factors for REIT to be extremely successful in India. The other one from an investor perspective is getting to 12 months as against 36 months so that it increases the liquidity in the market. People end up doing more trades once they have crossed the 12% holding period. The other one, as we discussed on the earlier slide, the dividend distribution tax is only available to an entity which is 100% held by the REIT. Now, we have a lot of cases where the assets are actually owned by multiple shareholders, some of them being state governments which are unlikely to migrate to a REIT structure. Now, in such cases where the sponsor is not able to 100% migrate to a REIT structure, the DDT does end up being a cost and ultimately impacting the returns. This is one change. Again, if the finance ministry looks at it and is positive about it, I think it'll go a long way in helping the REIT industry. For anyone who is looking at this, how can they be REIT ready? Right? Given that the government and the regulators have done so much to create a framework which actually works in the market, and we've spoken to a lot of foreign investors and they're very, very impressed with the way our REIT regulations are. So given that there are assets, given that there are investors, how does one really become a REIT ready? In terms of development, you need to, today when you are at the development stage, set up a platform which can be easily migrated to a REIT structure. That should really be your first option in terms of exit or in terms of growth, because what we are seeing is a lot of structures which were set up in the past, migrating them to a REIT itself is becoming a big challenge, because of which a lot of people are hesitating. A lot of time is actually being taken to implement the migration process. That's a very, very critical step for anyone who's looking at ultimately doing a REIT. Second, you can look at an AIF structure today, which helps you do the development, and then the entire AIF structure can be migrated to a REIT structure. Third, again, a lot of people have been doing this, but extremely important, housing the projects in different SPVs and having an appropriate capital structure between the SPVs, so that when the migration happens, the cash extraction in the REIT model is very, very efficient. And the last two, again, extremely important to have the right strong corporate governance standards, because REIT has a very strong corporate governance framework. It really is a model which investor is investing, having regard to the faith in the sponsor, having faith in the manager, and the entire corporate governance framework. And ultimately, it is about building a brand. Today, we all know if there's a particular brand, it gives a lot of confidence, especially in the mutual fund industry. Today, just because of the brand, someone has a higher AUM as against someone else. What we see as a future of REITs, yes, there are a few more roadblocks. The biggest one being the yield that is available to investors today, the yield which is being expected by the investors, and the yield which is being offered by the property owners. There is a bit of gap. Once that gap is bridged, I think this is the roadblock which will definitely be crossed. The other one is hedging cost for overseas investors. Once the hedging cost impacts the returns, it's really not something that they are keen on doing right now. A lot of developers are rethinking on this model, whether it really makes sense, given that a lot of financial institutions are actually ready to give lease rental discounting loans to the developers. So why should they really go into a listed market when you really have a line which is easily available? And obviously there's a regulatory oversight from SEBI, because then you are effectively a listed trust. These are today the major roadblocks, but I think these have been the roadblocks in every successful REIT globally. If you look at Singapore, for example, they took 3 years for the first REIT to come. The law was introduced. For the first 3 years, there were no REITs. Obviously, some of these were roadblocks, and the government and the regulator worked together with the industry to solve some of them. And now we are seeing Singapore as one of the best REIT markets. And if Singapore can do it, we certainly believe India has the right framework, the right regulators, and the right market for it to be one of the biggest REIT industries in the world. With that, I end my presentation. I hope whatever I've said, you found that useful. I'm happy to take on any questions that you may have.
Yes. So the first question is from Pawan Arora. How would be the return of REITs in comparison with INVTs, quantitatively as well as qualitatively?
So I would think both are very different models. They both have very different underlying investments. So to be fair, it's not something that I would like to compare. Real estate is a very different asset class. Infrastructure is a very different asset class. Within infrastructure, you have multiple asset classes: roads, power, ports. So I would say it's not a real comparison of apple to apple. You're comparing two separate products. But if at all I have to take a guess, I think the way the model is and the way the infrastructure industry is organized in the country, you will have a little more stable return from InvITs and a little more ballooning returns from REITs.
Next question is from Mr. Samangaonkar. Please let me know which REITs are in pipeline in near future and what return on capital can you expect?
So what REITs are in pipeline, that's something which we are really not aware, because a lot of people have been talking of REITs. Most of the property owners who've got grade A assets are thinking of REITs. The return expectations can be in the range of 6 to 8% or 7 to 9% in terms of total yield, depending upon the asset class and whether it is an asset which is fully matured or whether it is an asset which is in the initial phase.
One more question from Mr. Samangaonkar. What are the double taxation challenge facing here? What changes are required to take to make sure they perform?
I think the two ones which are really important from a tax perspective is, one, reducing the holding period for unit holders from 36 months to 12 months, and second, the dividend tax leakage, as I said, for a two-tier structure. That is, if that is solved, then I think some of the tax challenges will certainly be reduced.
Question from Dr. Kishore. How are property appreciations captured in the value of the units? Will it be like equity shares valuation?
So the way property upside is captured in unit here really is, for any commercial asset, the upside comes from rental escalations. And as I said, the rental escalations will result in extra cash flow. All the extra cash flow will be distributed to the unit holders. So yes, there is a mechanism through which the escalation will be captured, and it will obviously reflect in the market price of the unit when it is listed. The only thing is you will not have too much fluctuations because these are dividend kind of products. So the one which is closer to dividend date will be a little higher priced, and the moment dividend is declared, it will be an ex-dividend unit and the price will fall.
Question from Anand Prakash. Can we invest in REITs at the initial booking stage or at the time of completion of the project?
It has to be once the project is complete and rent generating. One can invest in an initial phase, but it has to be restricted to 20% of the overall size of the REIT. So if it is a REIT worth 1,000 crores, not more than 200 crores can be invested in the development phase or the construction phase.
Question from Akash. How much single investor can invest in REIT?
A single investor can invest how much ever they want in a REIT. There is you can pretty much invest based on your capacity. Though also the REIT should have 200 investors.
Next question from Swagata. Please elaborate as to how much income will be generated by the real estate. Is it through rentals, capital appreciation, etc.?
It will be through a combination of both. Basic income is obviously the rental income, and as the lease period goes on, there are escalation clauses and there are market adjustment clauses. That is what will give the REIT the capital appreciation. So once the 9-year period of a lease expires, there is a market adjustment clause, and if the market has moved and the rentals in that particular locality has increased, you can actually charge the fair rent. So you should expect a combination of both, but your regular cash flows will be largely a function of the rentals.
Next question from Jatin Sharma. How can a real estate agent be benefited from REIT? Can they trade them?
Sorry, I missed that question. Can you repeat?
The question is, how can a real estate agent be benefited from REIT? Can they trade them?
A real estate agent. So a real estate agent, like any other investor, can invest in the units of REITs. And since they will be listed on the stock exchange, you can certainly trade them as long as you are not amongst the lock-in investors.
So, next question from Vivek. What is the impact of GST in REITs?
The impact of GST on REITs really is only to the extent of rental income of the SPV. Earlier it was subject to service tax, now it is subject to GST. So if the cost of operating the lease has gone up, then to that extent the returns of REIT holders will be impacted.
Next question is from Sakshi. SEBI has proposed that REIT assets should be valued once a year with an update after 6 months. Do you think frequency of valuation of REIT assets are fair to capture value fluctuation?
So in the context of REITs, given that these are stabilized assets, the value is unlikely to be very fluctuating, given that these are lease contracts which are up to 9 years. So I don't expect fluctuations to be there. However, this is something which is only prescribed by SEBI. You can always have the manager do valuations which are much more frequent. You can do valuation on a monthly basis or on a 6-month basis, but an annual valuation is something which SEBI has said is mandatory. So there is nothing which stops the manager from doing a much more detailed valuation every month, let's say. But it's not going to substantially change is what we believe.
Next question from Kumar Khatri. By when do you expect the first REIT to be listed in India, and who are the front runners for the listing?
I don't know who are the front runners for the listing, but we do expect listing of a REIT to happen somewhere in the first 6 to 8 months of the next calendar year.
Question from Rahul. Is the REIT limited to office space, or can it also buy hotels, warehouses, malls, etc.?
A REIT can pretty much buy any real estate asset which is leased and is a lease generating asset. So it can be a hotel, it can be a retail mall, it can be a hospital, it can be office complex, it can actually be residential housing which is leased. You have globally the concept of rental housing, and some of them are actually owned by REITs.
Question from Shobhit Batra. What will be the minimum amount of investment?
The minimum amount to start with is 2 lakh rupees for an investor. The unit size is going to be 1 lakh rupees. Now, in terms of sizes, it will eventually come down once there is more and more investment, is what we understand.
Next question from Sandeep Tiwari. How the distribution would happen in market? Would there be certified distributors as in case of mutual funds?
Yes, there would be investment bankers and merchant bankers who would be selling this particular product. So there will be bankers who would be running the mandate from a particular developer to sell his REIT. So it's going to be like an IPO process, but it's not going to be like a mutual fund process where there are multiple mutual fund distributors in the market. I think the number of distributors or bankers in this case will be very few.
Question from Parth Sejpal. Can you please compare REITs with AIF, including return from each?
If you compare, I think again it's not a fair comparison, because AIF is really the growth capital. So when you invest in an AIF, the AIF is going to invest in unlisted companies, primarily in the growth phase, and your exit is going to be 3, 4, 5 years later. You really don't expect too many dividends in that sense in the period of investment. As against that, a REIT is a much more regular dividend paying product. So in fact, you should have both these products in your portfolio if you want to really diversify.
Next question from Sehal Bhatt. How comparable are returns from Indian REITs post-hedging vis-a-vis Singapore or US REIT yields?
So I would say yes, that the hedging cost as far as the Indian rupee is concerned is certainly high, and if we take up hedging cost of 3 to 4%, certainly a 8% return certainly looks like a 4% return, which is in some extent a bit lower than what a Singapore or what a US would offer. But again, as I said, a lot of these guys already have exposures in some of these markets, and they are definitely looking at India as a market on an independent basis.
Question from Samir Gupta. Projects covered under REIT would be only for lease assets, or they could be something from hotel, which are operating on management contract or franchisee with international hotel chains?
So these kind of hotels will not technically get covered in REITs, and my sense is they might technically get covered in InvITs. So if a hotel operator wants to do a model like this, they will have to go under the InvIT regulations and not the REIT regulations.
Question from Preeti. Why should someone take a risk of investing in REITs if the maximum return is, as you said, is only 9%? What is the time for this? What is the timeline for this in return?
So if you ask me why should one invest in REITs, the person who's investing in a real estate asset today is making a similar return. The only advantage of investing in REITs is you are saved of the hassle of actually owning the property, which has stamp duty cost, which has got maintenance issues, which has got to some extent lack of liquidity because it's not something which is easily sellable in the market. So if you compare to that, investing in REIT makes sense. But if you are already earning 30, 40, 50% return in the listed market space, you are not obviously going to take that money out and put it into REITs. It's a good product to have in your overall portfolio, but it's not going to be the only product in your portfolio.
Akshay Shah is actually asking you to elaborate on the benefits from stamp duty.
So currently there are no benefits under the stamp duty regulations in India. Globally, a few countries offered stamp duty benefits to real estate players for migrating to REITs, and Singapore being one of them. When Singapore REITs were launched, there was a 5-year exemption for real estate developers to migrate their assets into REITs. Currently, our country does not have those kind of exemptions.
Question from Harry Parekh. Are there any restrictions on a foreign resident investing on REIT, or whether he or she needs to meet any?
No, there are no restrictions for a non-resident to invest in a REIT or an InvIT. It's completely allowed under the automatic route. The Reserve Bank of India has already permitted that to happen sometime last year actually.
Question from Vaibhav. Can you share success of hospitality REITs in Singapore or US markets?
So Singapore obviously is a very, very diversified market, and if you go onto their website, you'll see all sorts of asset classes, and in particular, hospitality has seen a good trend on the Singapore market. I'm not too sure about the US one, but Singapore definitely, a couple of them have seen good success, and that data is pretty much available on the Singapore Exchange website.
Next question is from Amit Khanna. Can a REIT listing raise primary as well as secondary funds, that is funds for giving current investors an exit and or funds for further investments?
Yes, it can do a combination of both, just like in an IPO of a company. You can do primary as well as secondary. You can definitely have the promoter and the existing investors do an offer for sale, and you can also raise further money for doing investments. There is also provision available to do a follow-on offer in case the REIT wants to go out and buy further assets.
Question from Bhavya Gupta. Which asset class can be diversified with REITs?
In an investment portfolio, I think you can have REITs as one of your defensive investments, which will give you a stabilized return year on year. And with that, you can obviously have your equity investments and your portfolio investments and your mutual funds.
Next question is from for the physical asset or facility management of the assets of a REIT? Will they be appointed by the REIT or the sponsor?
It will be the responsibility of the manager to take care of all those things. So the manager really has to appoint the facilities manager and the project manager as and when it thinks fit, or if the manager has the capabilities in-house, they can also render those services.
Question from Sudhir. Does a small-time builder get supported REIT?
So I don't know the definition of a small-time builder, but from a REIT perspective, you or a collection of the sponsors together need to have a net worth of 100 crores. So if your net worth is less than 100 crores, then you're not eligible to form a REIT.
Question from Sriram Balakrishnan. Real estate is presently still not one nation, one tax. Is REIT foreseen?
So one nation, one tax is largely on the stamp duty part. Apart from that, I think in terms of GST as well as in terms of the income tax law, it's really the same tax as is applicable throughout the country.
Another question from Swagata. What is the difference between equity REIT and mortgage REIT?
I don't think so. There is a concept of equity REIT and mortgage REIT in India. Effectively, it means the kind of assets which the REIT is investing in. As we explained on the diversification slide, the REIT needs to invest in assets. It can also invest in mortgage securities, but it is not mandatory for it to invest. So in that sense, it's the two units which is the two assets which the REIT will own, the assets as well as the mortgage securities.
Question from Shima Prasar. In view of the recent spur of cases of insolvency of real estate projects, can REIT be used as a model for raising funds for insolvency management of cash-strapped developers?
If the assets are good and if they qualify in terms of the lease rentals, then yes, certainly it can be used. Someone needs to take the ownership of moving them to a REIT, and there should be a manager who's willing to manage those assets.
Question from Pulkit. Can REIT invest in real estate asset situated outside India? If yes, then implications of foreign tax. This is the last question.
It's not yet permitted to invest outside India. Right now, the only exposure a REIT can take is for assets in India. And there are enough assets today in India which can be migrated to REITs. So there's no real need to look at assets outside India.
All right, so we'll close the webinar today. Thank you, Bhairav Dalal, partner, Real Estate Tax, PwC India, for the presentation on the topic, REITs moving into the fast lane. Dear attendees, unfortunately, we won't be able to take all the questions due to time constraints. If you have any other questions, please send them at editor@etrealty.com. It was an engaging and insightful talk, and hope all the participants have enjoyed the session. The recording of this webinar will be available on etrealty.com. Thank you everyone for joining us. Goodbye.